Next week, credit policy is due, and ahead of credit policy, what exactly are bond markets pricing in? Are bond markets pricing in just a CRR cut or a CRR cut and a rate cut? Let's take that thought forward with Neeraj Gambhir, Managing Director in Co-Head Fixed Income with Nomura. And joining me live in our studio is Chaitanya Pandey, Head Fixed Income Group with ICICI Prudential. Gentlemen, morning. Thank you for joining us. Chaitanya, what are your expectations? Do you expect a CRR cut and a rate cut both?
I think a CRR cut for certain rate cuts probably less likely, given that it's March, the next policy is only a month away. I think he can wait. It'll be more, the first rate cut in April will be more effective because right now liquidity is what's driving markets and not really the rate as such. So I think it'll be better for him to cut rates in April than now.
Neeraj, hi, morning. What is your outlook on the current liquidity deficit and when do you see it easing?
I think the liquidity deficit currently of about 1.2 trillion INR is going to be here for some time. I think it could potentially worsen from here until the end of this month. There is a likelihood and there is a very high chance, as Chaitanya also mentioned, that there is a CRR cut in the policy. But if the CRR cut does happen, that it will probably become effective the next reporting fortnight, which will start on March 23rd. So we do see that from here onwards the liquidity deficit will probably worsen, may go towards 1.7 to 1.8 or maybe 2 trillion INR, and from there onwards we will see government spending coming in the first week of April, and that's the time when we will see the liquidity deficit sort of reducing. So given the current maths on liquidity, given the fact that there is a very large advance tax payment which is due to the government in this month, towards the second half of this month, so we do see that liquidity will probably not be easing from here onwards.
Chaitanya, apart from CRR cut, what are the other instruments Reserve Bank of India can effectively use to inject liquidity? Because so far they have gone with the OMO route. That has worked, that has not worked, that is debatable. But the bottom line here is that we still have a shortage.
Yes, I think, CRR and of course a temporary SLR cut, both of them can be used and likely both of them will be used. It's also possible that the RBI may again do a CRR cut with retrospective effect from the start of the fortnight. So since it comes in the middle of the fortnight, it will help ease the liquidity significantly post advance tax.
Neeraj, what is your sense? Is the RBI going to move on CRR cuts and leave the rates unchanged?
Well, I would think so. I think there are several things on this on the table right now which are not very comfortable from a rate cut point of view. I think the inflation rate itself is probably going to inch up towards 6.9 or 7% handle. The core inflation itself is not eased off. It's still at about 6.7% and probably will continue to be there. It may ease off a little bit going into the next year, but it's still not sort of fully comfortable. The food price component of the inflation is also sort of is likely to show an upward bias going forward from here. So I don't think things are fully there from an inflation standpoint. Just before we got into the bond story, I think the previous speaker was talking about a demand from oil companies to increase oil product prices. If that does happen before or after the budget, there is going to be an impact on the inflation. And so I think overall from an inflation standpoint, we are not fully there. From a growth standpoint, obviously we've sort of slowed down quite a lot. We are in 6% handle. Probably it looks like that this may be the bottom from a growth standpoint, and you could have things picking up a little bit in the next half of this year. So I would think that there is a bit of a wait and watch on the rates cut front. So I think a CRR cut for addressing the liquidity shortage and liquidity situation is something which is highly likely. A rate cut or any other rate signal probably has to wait for maybe a couple of more months. Maybe April policy is a more likely time frame when the rates cuts.
Right. Chaitanya, what is your outlook on inflation during FY13?
Well, I think inflation will remain relatively subdued. 6.5 is probably a reasonable number for FY13. But the reason for RBI cannot really expect the government to cut the deficit and at the same time crib about the consequent impact on fuel prices. So I don't think fuel prices are so critical. I think manufacturing is slowing at a reasonable clip, and that should take care of RBI's bigger worries, primary worries on inflation. So I think RBI will start cutting and probably cut 100 basis points at least in the first half of the coming year.
Chaitanya, for this fiscal, whatever could go wrong has gone wrong for Government of India. Revenues are down, expenditure has gone up, government borrowing has gone completely out of whack. So from the budget, what do you expect to hear when it comes to government's borrowing target for FY13? Because that will tell us where deficit is headed. That will tell us what are the assumptions and how much they plan to spend.
I think they probably borrow roughly the same as they borrowed this year, which will give them about a 5.1, 5.2 number, or maybe a 5 number, depending on what growth or revenue growth targets he puts in. I think that's something that's probably as good as can be expected. I think he will budget in some kind of reduction in fuel subsidies, a diesel price hike, and an LPG price hike are probably on the cards in March or in April itself. He raised them the same time last year, so that's really just the same. It's just taking care of the base effect drop in which would otherwise have happened. So that shouldn't really trouble him too much.
Neeraj, what do you expect to hear from Finance Minister when it comes to government's borrowing target for FY13? Because that is one number which will tell us what the Finance Minister is planning, thinking.
I think the market, borrowing number per se is important, and I think that it will be in the same handle as we did last year, which is basically this year. I think more than the borrowing number, the market is going to look at what are the real plans towards deficit reduction, and what are the concrete medium-term steps that are being taken to make sure that the deficit number stays within what is sort of forecasted at the beginning of the year. Last year was a year of a large slippage. Whatever was announced in the budget, there was a significant overshoot of that through the year. So the market is going to be watching for fiscal arithmetic, how reliable the fiscal arithmetic looks like at the beginning of the year, and whether the number that is being put out there is something that sounds credible from the overall growth standpoint and revenue growth standpoint. So those are the key areas which the market is going to be watching for. There are a few ways in which the optics of the budget can be managed at the beginning of the year. For example, last year they budgeted in about 40,000 crore worth of disinvestment. You've got to figure out, what is the number that they plan for and whether that is achievable given the state of the current, state of capital markets. So those are the things that the market is going to be watching for beyond just the headline, fiscal deficit number and the borrowing number itself.